Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to the Colliers Talks podcast. I'm Adam Jacobs. I'm the head of research for Colliers Canada, and I'd like to introduce our two guests more than we normally have. We have Robin McLuskie, who's our head of hotels here at Colliers, and we have Jeff from Invest. Jeff is the Senior Vice President of Asset Management at Invest, which is Canada's largest hotel owner. So he's got a lot of insight to bring to us from the operational side, from the sales and investing side. They've got a portfolio of over 100 hotels across the country. So I think we can talk with good authority on what's happening in the hotel market. And I think this is a positive episode. I spend most of my days thinking about interest rates and return to office, where the mood is, a little more negative. It's a little more of an obstacle. I think hotels is a real good news story that people might not be aware of. It maybe doesn't have the level of discussion in the media of, say, downtown return to office. But I'm really looking forward to a positive spin. Robin and Jeff, please introduce yourselves. We'd love to hear from you.
Yeah, no, absolutely. It's a real pleasure to be here. I'm managing director of Colliers Hotels based out of Toronto, but we're a national hotel practice specializing in hotel brokerage. Jeff and I have known each other over 20 years in this industry, and, we've seen Invest through various cycles. We're proud to have sold, I was looking at the number, 65 assets for you guys as you've gone through sort of pruning off non-core over the years. And so it's been a real treat to work with you and your team. We've also proudly been involved in some of the landmark transactions you guys have bought over the years, which I think we'll jump into a little bit later. And that's the St. Regis here in downtown Toronto, as well as this year we sold the Banff Hotel to you. So yeah, I think Jeff comes with a real tremendous experience and across all the market segments for hotels.
Yeah, Adam, Robin, thank you so much for having me here. As Adam mentioned, I'm the Senior Vice President of Investments and Asset Management for Invest Hotels. Invest Hotels is Canada's largest vertically integrated hospitality organization with over 90 owned hotels and over 100 managed hotels. So we have internal management of our properties.
Okay, well, I'm sort of a numbers and data person, so I'm not in elbows deep in the nitty gritty of hotel operations the way you are. But when I just look at this big picture, the data that we have, or the data that Robin has kindly shared, it looks very positive to me. It looks like, we all know hotels were punished by the pandemic probably more than almost any asset class. But when I just look at room rates and occupancy, I see a picture of basically full recovery, maybe even better than full recovery. So is that realistic, or is there maybe something I'm missing just looking at the top line number of, okay, here's the average daily rate of a hotel now versus 3 years ago, 5 years ago?
Yeah, I think I'm happy to start high level. I think, we definitely track all that through industry benchmarks. And I would definitely confidently say we're in a very good place in our industry right now. I think hospitality is the one to watch right now. I think there's a lot of funding and a lot of new entrants looking at the space. And a lot of that is to do with operational fundamentals being back to peak. I think the industry showed how resilient it is. To point to data, pre-COVID in 2019 at our peak, our industry was 65% occupancy across the country, and average rate was about 165, again, according to STR. Now we're 67%, so up slightly on occupancy, but rate is just shown tremendous strides. We're up over 30% in rate. We're at about $212. I think Jeff will get into it just because he's got the more national perspective on the different segments within the asset class. But I think confidently we can say as we got through it, we're in a good spot.
Yeah, absolutely. Fundamentals are very strong. And despite the fact we're back to pretty well peak occupancies across the country, we still have a number of market segments that haven't fully returned. So international inbound traffic still is lagging the pre-pandemic period. As well, we'll call it your Fortune 500 business travel traffic. It's nearing, getting closer, but there still hasn't quite hit the 2019 pre-pandemic period plays.
In terms of your portfolio, even this year versus moving into next year, how do you see budgets? I know you're in budget mode right now, just sort of high level. Is it, because I know there's a lot of owners out there saying that rate, there's only so much more movement. So they're seeing a little more flat, which not necessarily is bad, but just curious on your perspective.
Yeah, so our portfolio, I mean, we have done, as you mentioned, a little bit of changes in our portfolio over the last 10 years. We sort of pruned assets and bought, higher profile assets in cities. And we really focused on average rate in our portfolio. So our occupancy is actually about 200 basis points below our last peak in 2018 as a company, but we are outperforming in average rate the industry. So we still have opportunity on the occupancy side, and are extremely focused on that. Next year, I expect growth to be a little more tepid. So we're taking a cautious approach at the budget table. There's a number of one-time events, such as the upcoming Taylor Swift concert that needs to be looked at. Came in November in Vancouver or in Toronto, and will come in December in Vancouver, and so they are having a bit of an impact in those markets in Q4.
So then hard to replicate that next year with the managers. So sure, certain markets like that. Yeah.
And let me ask one follow-up there, because it sounds wonderful that rates are up and everything, at least from the operator side. But we all know, okay, let me throw a little cold water. We just went through the worst bout of inflation that we've been through probably in our lifetime. So sure, rates are up, but costs are up, taxes are up, insurance is up, food is up, everything is up. So there's two sides to this, I guess. There's the traveler side of maybe people don't have as much disposable income because of inflation, because of housing costs and food costs. And then I think people aren't aware maybe how labor intensive hotels are and how this trickles down to you. It's not a typical real estate asset in that it requires a lot more people. You have to provide food. You have to do all of these things. So how has inflation played out across your portfolio? Is this still a major issue? Is it just gone to sleep?
No. I mean, it is an issue. So for the traveler, we've already seen the effect of inflation, because one of the nice benefits of the up and the down of the hotel industry is we have daily leases. So we're able to reprice our rooms on a daily basis versus other sectors in real estate. So we've seen a huge benefit from obviously owning hotels in an inflationary environment, which is really a textbook case for hotels that have really proven out. Costs take a little longer to catch up to us, so there's definitely a lagging indicator. In 2023 at best, our EBITDA margin expanded about 320 basis points from the pre-pandemic period. We're anticipating giving over half of that back because of labor cost lags, just increasing in staffing. Coming out of the pandemic was hard to hire staff, so there was definitely a lot of vacancies in the business, and we have a lot of large union contracts that were negotiated before the pandemic or early days of the pandemic that are rolling now, and our frontline colleagues are definitely been impacted by inflation and are seeing sort of outsized wage increases coming into effect.
I'll just throw in one stat there, which is we were looking at some of this labor market data. We all remember 2 years ago, there's 1 million job vacancies in Canada. That's kind of come back to normal, but the one area where job vacancies haven't come back to normal is hospitality. Like, it's the number one area where there's a huge number of job vacancies relative to the employment base, more so than trucking or education or any of these other industries. So I think it wouldn't surprise me that there's still some pressure there playing out on your side in terms of hiring, turnover, wages, all of that.
Well, I think COVID was also an opportunity to get down to the skeleton of your hotel P&L, and I think that's why profitability is so strong right now, and it's an asset class to be watched, is because despite inflation, we are seeing profitability levels at peak for most hotels, and that is because there was that ability to work through the middle of that P&L where you've got higher rates, and yes, your labor costs and insurance and some costs are higher, but generally speaking, they've been able to keep costs in check and do that. That helps profitability.
Okay, well, let's talk. We've talked a little about the operation side. Let's talk about your specialty, which is the investment side, the transaction side. let's not assume our viewers know a ton about this topic. How would you characterize the investment market right now for hotels? It's more active than normal. It's a regular market. People are holding off. Where are we right now?
Yeah, I can start and then feel free to jump in as a buyer and a seller out there. We'd love Jeff's perspective, but I think I'll just set the stage. So yes, high level, we're definitely in a very active trading market. 2023 transaction volume for the country of Canada was 1.6 billion. This year, we're already tracking at over 1.7 billion year to date, September. So our predictions are we're going to be 2 billion or over by the end of this year. So that's some good growth. We're seeing that across the country. I'd say 50% of activity is Ontario, but we're seeing some real strong growth out in Eastern Canada and Alberta. And I think that's really because Ontario has just become so expensive. It's really hard to get into Ontario right now. So I think we're seeing a lot of buyers from Ontario say, you know what, I'm going to go out east. There's some really strong markets in Nova Scotia and Newfoundland. So we're seeing some trades happening over there. When you look at a price per room and other metrics, cap rates, we're finding that people are seeing some deals out there. Same with Alberta. It was a slower province to recover, and we are seeing some transaction activity happening there. I would say 80% of activity is private, so you're a lot of domestic, despite us showing assets to the U.S., and we'll see with the changes of the dollar that may come if we get more U.S. buyers. But I would say it's predominantly domestic, well-capitalized groups that are out there really looking for opportunities. I would say it's definitely more a seller's market than it is a buyer's market.
Yeah, I think underpinning that transaction environment is a strong debt market right now in Canada. There's lots of lenders looking at the hotel space now in the industry. I think as they're looking at their book and shifting away from segments such as office, they're looking for other opportunities. So we have a great domestic hospitality lending market now. Probably the best I've seen in my 20 plus year career.
Absolutely. I think just touching on the lenders, I completely agree. There's there's lenders that are really supportive of the space, and you're seeing that across the board of different assets. They're focused really on the sponsor though, like underwriting who that buyer is, what their business plan is. A lot of the transactions we're involved with are that going in cap rate might seem extremely aggressive, but it's because the hotel is in need of capital. It's underperforming. So a buyer can come in and work with the lender to say, you know what, give me 2 years, I'm going to turn this around. And so we're seeing really creative deals happening out there on assets that, need capital.
So let's talk a bit more about the transactions. We're saying volume is good. There's been a lot of activity, but give us the specifics. What are you looking for? It's about the location. It's about the demographics. It's about the brand. It's about the physical property. What's the defining thing that you're looking for as an investor?
Yeah, for sure. So having over 90 hotels across Canada and one in the U.S., a big focus for us strategically is where there's gaps in our portfolio from a geographic perspective, but also from a customer, guest perspective. For example, heading into the COVID pandemic, we really were underweighted on resorts, and resorts proved to be one of the more successful asset classes within our industry through the pandemic and even coming out of the pandemic. And so we focused on that. We've acquired 3 properties in Banff. We acquired the Algonquin Resort in New Brunswick, St. Andrews by the Sea. And they've proven to be phenomenal assets for our portfolio.
I think looking at what Jeff's just said at Invest does translate to other buyers that we've seen, whereas you come out of COVID and you're evaluating things and you think, wow, I've got a hotel in downtown Toronto, downtown Vancouver, downtown Calgary, I'll be fine. But when you have an event like that takes out the downtown cores that were the slower to recover than the outskirts, I think people were saying, wow, it actually is better to have also secondary, tertiary markets, not just urban. So resorts have become hugely popular because they definitely outperformed during those COVID years, and they continue to. That's capital gone into resorts as well. So, and then I think just on overall transactions and who's buying and why, I think you've got different buckets of buyers. There's some that are buying hotels that need renovation and repositioning, rebranding, and those are perceived as really low cap rate deals, but they quickly turn into profitable operations in a few years. And then you've got other buyers that are, yield buying. So they want the big cap rate. And that's why we were seeing more activity in Eastern Canada this year, because you can get up to those double-digit cap rates. They do exist on opportunities in secondary, tertiary markets that are so-called stabilized. But I think with our industry compared to other asset classes, it's just a unique one in terms of, the whole cap rate discussion of it's hard to paint a story sometimes, because the true in your cap rate going in is not necessarily your stabilized. So that's where you have to sort of understand the expertise of that Jeff and his team do in terms of how they can perform.
Yeah, I mean, underwriting hotel assets, certainly there's a lot more variability in it, because it really comes down to your business plan for the asset. Like other industries, you are looking at market rents, so what the overall market would be. So if you took downtown Toronto, you could get to an average hotel occupancy, average hotel rate, but then obviously underwriting the St. Regis is going to be very different than underwriting, the Chelsea hotel. So, it takes a lot of focus and planning in your underwriting phase to build out your business plan for any particular asset, and in the underwriting phase.
And your comment on Banff too, maybe just for the listeners, like you already owned in Banff as well. So I think in terms of what you're going after, do you find that there really are operational synergies and owning 2-3 in a market and how you play into that, or they are still independently evaluated?
Yeah, I mean, for sure in Banff, having 3 now, we have built some synergies. We have one common general manager, we have a common sales team, finance team, maintenance team. So it's definitely helped us in that market. The other thing in that market is, staff accommodations is a big factor. And so we've been able to sort of, bulk up our staff accommodations, and they serve all 3 properties. So we don't have to have, one building per property if we owned only one. So, we've definitely benefited by having 3 properties in Banff.
Okay.
Interesting to hear that, because so much of what we deal with on the office side is downtown has been disrupted so much. Like downtown has been the focus for so long, and now it has some unique challenges. So interesting to hear the same thing for hotels as well.
And what about the extended stay market? Are we hearing a lot of buzz on that in terms of the margins being better than, your full service? And when I talked about lifestyle is one to watch for new builds, extended stay is one as well.
Yeah, for sure. We have a handful of extended stay properties. We acquired a few more as part of our Morguard acquisition earlier this year. We acquired 10 hotels from Morguard. Certainly extended stay have always been very strong assets, high margins. What I would say about extended stay is, are they really extended stay, or are they really an extended stay hotel in a one day transient market? So, take Toronto Airport, for example. If you have a extended stay hotel there, are you really getting the duration of stay, or is it just acting as a transient hotel? And that obviously comes with higher costs from a cleaning perspective there.
Right. The sweet spot is when, is it 3-4 nights is is when you really feel the impact of that. I think in the US, the extended stay market is just so they really do see the segments more than we do. So I think that there's still some work to do in Canada on that.
Yeah, we are seeing, definitely a lot of building in the, we'll call it, you have your traditional extended stay. I'll, give a few brand names that people will probably recognize, like Residence Inn or your Homewood Suites, which would be kind of your full, kitchens. And a lot of developers now are building, we'll say, sort of the sub extended stay. So Home 2 by Hilton or Town Place Suite by Marriott. So we are seeing a lot of development activity in that segment, because they're extended stay, but they don't have the size of rooms that a traditional extended stay would have. And so they're much more development friendly.
Give us the view of, like, if you're an investor, and certainly the private investor dominating is happening everywhere. It's happening in the office market, in the retail market. It's just where we are right now. There isn't the presence of your pension plans or foreign investors quite the same way. But why hotels? Why, like, people are maybe a little more familiar with retail plazas or the boom that we had in warehouses, but where do hotels fit? Why is someone investing in hotels instead of downtown office towers?
Well, I mean, ultimately there's a premium return that comes with, managed hotel that has the right business plan. They're very dynamic. So there's a lot of levers you can pull with hotels to drive a return, from a brand, from capital renovation, from facility programming. So there's a lot of levers as an investor you could turn, and even just operational improvement. Really good operators can make a big difference on the bottom line of an asset. So I think, broadly, some of the reasons why people are focused on it.
Yeah, I would agree for sure. And I would just add, diversification. So we're seeing buyers that have invested in office and retail. And when we saw the dislocation of where office is, people are turning to this investment space because they are providing some good yields, good opportunities for the next 5 years. I think when you look at where supply and demand is, so we're seeing some buyers come into the space that are new to hospitality. They're aligning themselves with third-party managers, Invest being one of them, absolutely, and saying, you know what, I own in other asset classes, but when I prepare for the next downturn and as I move through cycles, I want to put hospitality into my portfolio. So we're seeing a bit of that.
And I'd say generally, assets outside the 4 core assets, that would be apartments, office, industrial, and retail, are very hot right now. Hotels being part of that. I've never received so many questions about self-storage, laboratory space, data centers, retirement homes. Like, these are maybe smaller assets, a little more niche, but I think people are searching around for that diversification, seeing a little more risk in the conventional but political risk or the challenges of downtown office, and maybe looking for some alternatives there. Okay, so we talked about operations, investment. What about development? I think we've heard a few stories where it's, and this is favorable for an investor, where maybe we're not building enough hotels. Maybe there's a shortage of hotels in some high tourist type markets on the coasts. So where are we in terms of like the construction side? Are we building enough? Is building on the upswing or the downswing?
I mean, as Canada's largest hotel owner, I'd say there's plenty of supply. We'd be in more hotels, but all kidding aside, certainly supply in Canada over the last 5 years has really been muted. Kind of 0.6% supply growth. Really it comes down to, the cost to develop in Canada continues to be very high, development charges, and just weighing, where the highest and best, use is for property. I'd say though, we are seeing more and more interest in the space now that, office has really fallen off and even condominiums. So you are seeing some more projects gain traction in the bigger cities. It will be interesting to see where supply growth is over the next few years. It is expected to be up north of 1% over the coming years.
Yes. Yeah, I would say definitely we're seeing more shovels in the ground now since it has been muted the last several years. I think not everyone has the stomach for development. So, we actually saw a lot of developers bidding on hotels that we were in the market with because the development market was just not at the right time with construction costs and fundamentals. I think when you look on whether you're going to build, it really comes down to how much can you charge, what's your room rate, and just from a very high level simplicity perspective, and rates just weren't matching what the cost was. But I think that's slowly narrowing. And again, going back to Jeff's point on lenders, the lenders are being supportive of new builds. The cities, certain ones do need absolutely new product, and so we are going to see that, but it's still in a way that's not going to negatively impact the market. Yeah.
And we've seen development slow down recently for almost every asset. Like office development is near record lows. Even industrial development is coming down from highs. Like it's difficult to develop between interest rates, land costs, labor costs, material costs. It's a difficult time. It won't last forever, but right now it's a bit of a lull.
Well, I would add what we do see is mixed use development. So the way projects can pencil is if you've got a for sale component with condos, or you're part of a mixed use project where there's some development incentives, and that I think we'll see a bit more of that.
That's interesting. Okay, so let's zoom out big picture a little bit here. What is the number one challenge to operating a hotel today? And I think the interesting part for me is how different is that from the good old days before all this disruption, but 2019, 2016, whatever the normal market you experienced was. What's different now, and what's the big obstacle everyone's wrestling with?
Definitely labor. And I would say, to expand on that, talent. So it's not just about having a labor pool, but talented individuals who have experience in the industry. I mean, we lost a lot of colleagues through the pandemic that moved to other industries. And, lots of industries are targeting our people because, of their ability to provide, hospitality experience. From car dealerships to retirement homes, to all kinds of other industries are very keen on our people. And so we lost a lot of talent through the pandemic, and it's really, about kind of, retraining, having that particularly mid-tier management, build the experience, back in the industry. So that's a big area of challenge right now for our industry.
Is that disrupted by COVID, or is that just kind of the tension always of like it's a high turnover industry? Like,
I mean, it's always been an issue, but COVID absolutely exacerbated it for her. Yeah.
Now let's talk about everyone's favorite topic: the banners waving on Yonge Street. The Eras Tour is here. The World Cup is going to be here in less than 2 years. How do these high profile events really, like, is it just it's a 2-week blip, or does it actually change the overall demand for hotels, the big pictures, their trickle down effects? Like, how we seem to have had a few of these, how do the really high profile, like, global type events impact the hotel market?
I mean, they bring profile to a city, right? So that's the number one benefit. Obviously, there's additional cash flow that comes during the event, but really the benefit of these events is it does bring kind of worldwide exposure to Canada and some of our top tier cities.
Yeah, I agree. I think it really does help to put us on the map. We need Taylor to come here, and it does bring more tourism, and it gets exposure for Canada. But I mean, from an investment decision or any major impact, it really doesn't, because they're not going to base a valuation decision based on a 2-week blip. But to earlier point on budgets, I think what owners are grappling with and arm wrestling their managers right now as they move into budgets next year is when you've got these big events that are really impacting the P&L. Those are just one-time events, so it's hard to repeat those. So, but owners are certainly taking advantage of the whole city is. So yeah, for Toronto, Vancouver.
Slightly less optimistic topic, but we had quite the wildfire season this year. So in Alberta or the Okanagan in BC, has this impacted the hospitality market in just either perception wise or operation wise? Is that just kind of a one-time thing that we don't have to worry about, or did that actually impact the demand for travel and hospitality there?
Yeah, so we operate 3 hotels in Banff. We don't have any properties in Jasper, where it was really affected this year from the fires. But speaking to the folks that manage the JPL, that hotel has reopened, and demand continues to be very robust into the Canadian Rockies. So we have not really seen any material impact from those events on demand. Now, if they continue to happen year after year after year, then sure, there could be an impact, over time of the perception of some of these destinations. And, really the unfortunate thing is they tend to happen during the peak travel demand period. So it makes it certainly challenging, operationally around those types of events.
Mm-hmm. Yeah, I think from an investment perspective, I mean, those like the Banffs and Lake Louise, all those markets are so highly sought after that it's impossible to build in these markets. And from an international tourism perspective, so I think people will always look to these markets. Yeah, it is devastating what happened with Jasper, but if we had a hotel for sale there, it would still garner strong interest because the tourism is just not going away. So I do think investors look at it on a long-term hold basis. And so as Jeff said, if they keep happening, I think we've got some concern here, but they do weather these storms. The industry is extremely resilient, and Jasper's back open and the Fairmont there and doing phenomenally well. So people want to, at the opposite, if you've got that, people want to come back and support the local market and get out and see it. So
I would tend to agree with that. Yeah. Okay. Zoom out, really big picture. I tend to be a big believer in the fundamentals, like demographics, the labor market. The big picture really drives a lot of real estate. So the demographic picture, record high immigration to Canada has happened. At the same time, you have aging population, baby boomers retiring, downsizing, all of those trends that have been here for quite some time. So how does the demographic picture impact hotel operators or hotel investors? I'd say it's generally been a favorable situation for real estate. Canada is growing more rapidly than Germany, Italy, Japan, the US, pick your country. But maybe it brings some unique challenges. We have an aging population like a lot of countries. How does that fit into this?
Yeah, for sure. I mean, probably the number one area where the hospitality industry has really been benefiting demographically is younger demographics value experience over material items. So, nowadays it's not uncommon for Generation X or millennials to say, we're not just doing the 1 week trip every 2 years. They're going on little excursions and doing experiences multiple times a year. That's really benefited our industry. Just that valuation of experience. Baby boomers are, significant travelers as well as they move into their retirement years. And we're certainly benefiting as an industry from that demographic along with the younger demographics.
Yeah, I think the brands, the big powerhouses, Marriott, Hyatt, Hilton, IHG, they're all really doing a lot of data research on what customer needs are. And when it comes to baby boomers, like security, and, I think everyone's looking into this tech base more and more, which has really been great in terms of like contactless check-in and certain things like that. But I think we'll continue to stay ahead of those trends. I agree with Jeff on, a lot of the product that's being built right now is that lifestyle. So people want, they don't necessarily want the cookie cutter brand. So the new development we are seeing is really within that lifestyle sort of soft branding, as they say, where you've got the ability to customize the hotel to the local market and bring in, fresh local foods that like appeal to the guests, and in terms of amenities, having open spaces where people can, work and mingle. And so the guest room's one part, but really reinventing the lobby space and the check-in, I think, is just going to continue to branch off as being important to folks.
And I would say that's a trend across almost all real estate. Like we see the same story in retail. We're seeing the same story in office now. Like the cookie cutter versus boutique customized is you can look at the building across the street from us as we're doing this interview, and they're going through that very transformation of, okay, it's more food focused, it's more youth oriented, there's less chains, it's more independent. That sort of trend, I think, is just across every single real estate asset. Okay, I think that's about it for the Q&A section. I'd like to thank you both, Robin and Jeff, for being the guests here, for all the insight that you brought here. This was our Colliers Talks episode on the hotel market in 2024. So thanks so much for being here.
Thank you.
Thank you.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.